enough, we've done a lot of work over the years. We just updated on what we call a debt bomb. And that is the question of what is the rate at which the interest on the debt, which of course is part of the deficit, becomes so great that the whole thing grows geometrically and blows up. Now, the interest rate on the federal debt now is under 3% because a lot of it's short term. But of course, it rolls over in time at higher rates. So if we stay here, it could be a problem, although our numbers show that unless you got 8% on the federal debt.
The average 8, and we've never been there, right? Because I remember reading...
The average maturity is only 6 years. So until you got to 8%, you probably didn't have a problem. But we've never had that problem. We've never had a debt bomb. The closest we had was 1992, when interest in relation to GDP was 3.1%. It's now 3%. It's basically the same. So we haven't been there. We're not Argentina. But you know, this is obviously a concern because if interest rates are up and stay up, of course, there's a lot of other things you worry about. I mean, you know, the economy, I don't think, could stand anything like 8% interest on the federal debt because you'd be talking about double digits for everything else, and we haven't seen that since the Volcker era and the ensuing collapse.
Well, now there's a lot of things you've done in your career to become such a famous economist. Probably the biggest is you're a bond bull, and were for throughout the bond bull market, and really made your name with those calls. How painful then has this drop in price, run up in yields been for you? And at what point do you say, okay, now it's time to buy again?
Yeah. Well, obviously, when you've had a long-term forecast, and you might recall, Matt, when I said in 1981 that we're entering the bond rally of a lifetime, the yield on the 30-year bond was 14.6%. It was a long time ago. Obviously, it came way down. Now it's rebounded with all other rates. I think we're getting close because the economy simply cannot stand these kind of rates. We're close to, or maybe already in a recession. It's always up to the National Bureau of Economic Research to make that call. But I think that will do it. And of course, you get a recession. What happens? You get less demand for high quality credit. You get the safe haven of the treasuries. You get the Fed easing. But I think the Fed is going to be slow to ease because they want to make sure that inflation is killed and killed dead. They really are. We're so far behind the curve on this. So I think this whole thing is going to get stretched out. But I don't think we're quite there yet where I will go out. We in our portfolios we manage, we do have some long bond positions, but relatively small. We're not adding to them right yet.
Is there irrational investor exuberance back in this market?
Well, it sure is. I mean, if you look at example at the FANG index,
yep,
growth stocks. Now, to the extent that their prices today are the discounted value of future earnings out 5 or 10 years, those things ought to be in the tank. Now they've sold off a little bit lately, but I mean they've rallied for most of the year, and of course this is a big thorn in the side of the Fed because they see investors really not believing them. They just don't really believe that they're serious, because if they did, you'd see a lot of things like this. You'd see stocks in general, and say the FANGs, the interest rate sensitive, housing already affected by interest rates, but investors in terms of securities not yet convinced.
So you think, or I guess, do you think that there's really risk to the stock market in general?
Oh yeah. Early last year, I said I thought we'd have a 30% decline peak to trough. We were down 25%. You got a rally. That means from here you need about a 30% decline. And yeah, I think there is big risk. I mean, you look at all the indicators. You look at the leading indicators. You look at the yield curve. You look at small business hiring intentions. It's just a whole host of factors. And boy, if this doesn't tell you recession and all that goes with it, including Fed ease, a lot lower rates, you got to throw out all the history books.